Prepare for a seismic shift in the housing market, as a number of economic metrics are clearly pointing towards a major correction in home prices very soon. We're also seeing major institutional investors, including some of the leading real estate investment trusts, selling off their property portfolios and in some cases pulling out of the market altogether. The Case-Shiller Home Price Index has been extremely resilient up until now, only falling by 2.3% from the peak seen in July 2022, and we've even seen the market rebound slightly since the start of the year, leaving many people in absolute shock. However, all of this could be about to change soon, and today I'll dive into the economic data that suggests this. It all starts with the Federal Reserve, who are pivoting on their monetary policy stance and recently announced an interest rate pause. This puts an end to the 10 consecutive rate hike streak and is the first time that rates haven't been hiked in over 15 months. However, this pivot is likely to be short-lived, as the median expectation amongst the members of the FOMC is that the federal funds rate will rise to 5.6% by the end of 2023, up from between 5 and 5.25% today. This means that we are likely to see another 2 rate hikes before the end of the year, which would therefore put more upwards pressure on mortgage rates if this does indeed happen. And with mortgage rates likely to stay at this elevated level for the foreseeable future, it means that buying a home with a mortgage is more expensive and reduces consumer buying power in the market, overall reducing the demand for homes. Housing affordability is already a major problem, and the housing payment to income ratio has once again risen to above 34%, which brings it back up above the peak that was seen during the global financial crisis. The last time in history where housing has been this expensive relative to average income was back in the 1980s, and we can see the exact same story in Redfin's homebuyer housing payments data, which has seen truly astronomical growth over the last few years. The average housing payment is now up to $2,640, an 8.2% increase year over year, and far higher than during 2020 when the figure was more like $1,500. That means that the average homeowner is now paying $1,140 extra a month in housing payments compared to just 3 years ago, which is a whopping 76% increase. And of course, any further rate hikes that happen later on in 2023 will only drive mortgage rates up even higher and make housing more unaffordable. For the payment to income ratio to revert back down towards the mean, we either need to see interest rates fall or house prices fall. And we know that mortgage interest rates are high right now, but they are likely to remain high for the foreseeable future given the current FOMC outlooks for the Fed interest rate hikes in the coming year, especially given that interest rates were commonly this high further back in history before the global financial crisis. And wage growth is not going to bail people out of the housing unaffordability problem either, as it is fairly stagnant right now, growing by a slow but steady percentage every year. Logically, all signs therefore point to the most obvious factor and metric behind the payment to income ratio, and that is home prices. Now, the housing market has rocketed in recent years, and the gains that we have seen have drastically outperformed the mean housing market growth historically. Home prices are widely considered by many people to be overvalued right now, and these high home prices are the main driving factor behind the abnormally high cost of housing that we are seeing today. Home prices falling is therefore the most likely way for us to see the payment to income ratio return back to normality in the future. We already know that demand for homes amongst home buyers is at an all-time low right now, and that can be seen clearly in the latest mortgage purchase applications index update. The index has reached 163.2, which means we are now at one of the lowest points in history, pretty much on par with the lows that were seen during the global financial crisis as well as the aftermath of this. Housing is just so unaffordable right now due to average income not keeping pace with home prices and interest rates, and it means that there are not as many people out there who can afford to buy a home today. With interest rates set to remain at their current highs and likely rise even further towards the end of 2023, then it's only going to harm the demand for homes even more. American citizens and families are not the only group where we're seeing a drastic fall in demand for homes though, as we're also seeing it across the investing world, with institutional investors slowing right down on their investment in real estate. We've already seen the largest institutional investors and iBuyers reduce their home buying activity by close to 80% by the end of 2022 compared to a year prior, according to John Burns' research. And this annual decline has increased even further to 90% at the start of 2023. Recently, Starwood Capital's CEO announced that the firm is exploring the sale of more than 2,000 single-family homes. Now, these homes are part of the Starwood Real Estate Investment Trust portfolio and were mainly acquired in late 2021. Now, the REIT owned 3,210 single-family rental homes valued at $1.26 billion as of the 31st of March, according to a filing, so a sale of 2,000 homes would be an extremely significant sale if it was to go through. Starwood Capital will join two other giant REITs who are selling off their portfolio, American Homes for Rent as well as Invitation Homes, who are the largest owner of single-family rental homes. Both of these massive REITs recently became net sellers of homes, painting a clear picture of the direction that these funds predict the housing market to head in the near future. With overall demand for homes down at pretty much all-time lows across both homeowners and investors, then why are we not seeing home prices crash yet? Well, demand is not the only factor that determines prices, as supply is the other driving factor. When it comes to supply for homes, it's very clear that the current home shortage across the US is propping up the housing market in a major way and preventing home prices from falling. Housing inventory levels are currently at very low levels relative to recent history and far lower than they were pre-pandemic. The number of people who are locked into their current home due to the current extremely high interest rates is also contributing towards this, and many existing homeowners currently have a mortgage that is far lower than the current market rate and are therefore very reluctant to move homes. This is overall reducing the number of homes that are put up on the market, but this could completely reverse soon as a tidal wave of supply will be hitting the market in the coming years, and we recently saw that May housing starts soared along with the number of housing permits being issued and the number of homes being completed. As you can see from this chart, there are currently a large number of housing units under construction relative to recent history for both single and multi-family homes. Prominent economic research companies as well as real estate companies have come out with bearish predictions on the future of the housing market, including Capital Economics, who believe that the pause in house price declines will prove temporary. This report argues that home prices will switch back to correction mode in the second half of 2023, despite the resilience that we have seen in the market in recent months. Rates rising once again and a weakening economy are the main reasons why Capital Economics believe that this will be the case, and they expect sales to remain low while price growth turns negative. To add to that, the CEO of one of America's most prominent real estate companies, Amherst, has come out and said that he believes that the US housing market is overvalued by 40%, a very bearish claim to make. Amherst manages $16.8 billion in capital for investors and is one of the largest owners of homes for rent in the US, with a portfolio of approximately 44,000 homes. If you want to know a bit more about this balance between demand and supply for homes, then I dive into it in a bit more detail in my previous video, which you can check out on the screen right now. Aside from that, please do leave a like on the video if you enjoyed it, that does help out a lot. Also, be sure to subscribe as well for more videos in the future, and thanks a lot for watching.